Thank you for joining us for this month's National Economic Outlook, written by Local Market Monitors founder Ingo Windsor. Ingo is a graduate of MIT and Boston University, and he's not your typical economist. He has a knack for presenting complex facts in an easily understandable way. So without further ado, I'll turn it over to Ingo.
Thank you very much, Julie. Every month, we look at the latest data to see what they can tell us about the economy and about real estate markets, where they are now and where they may be headed. You make better investments when you have a better idea of the forces that affect supply and demand. This month, not much has changed from last month, and we're unlikely to see better economic growth in the near future. Considering the low rate at which the population is growing, maybe not for several years. This can have dramatic effects on real estate markets, which are now heavily overpriced. Let's look first at the overall economic picture. The best way to see how the economy is doing is to look at the rate at which it's creating jobs. Jobs means consumers, and consumers are the U.S. economy, at least for now. Here we see the percent increase in jobs every month compared to the same month of the previous year. The trend has been downward for years and is now very close to zero. That's partly because jobs in the manufacturing sector continue to be lost. It's still cheaper to make products overseas, even very sophisticated ones like computer chips. Job growth in construction would be very close to zero right now if it weren't for the sudden boom in data centers. Meanwhile, home construction has been shedding workers. Surprisingly, the last couple of months saw a small uptick of jobs in the retail sector for the first time in years. And there's good growth at restaurants. There's also an uptick of jobs in healthcare, mainly because of renewed hiring in the very large home healthcare segment. Let's note here that the new jobs in home healthcare, in retail, and at restaurants are all low-paying jobs. Jobs in finance, on the other hand, pay much better. But as we see here, these jobs are being cut, very likely due to greater use of artificial intelligence. In the large business services sector, there's also finally an uptick of jobs after several years of losses. That's mainly because companies have finally cut all the temporary workers they no longer want, 500,000 of them. But companies that provide computer programming services are still cutting high-paid jobs at a high rate. Finally, the big government sector has lost some 300,000 jobs, mainly at the federal level. The bloodletting seems to have stopped now, and maybe we can expect a small amount of new hiring in coming months. In summary, job growth is very low. We have new jobs that don't pay much, and we've lost a lot of jobs that paid much more. Other economic forces also don't give much cause for optimism. Energy prices, here represented by the price of crude oil, remain high, and they will stay high despite new negotiations in the war with Iran. Food prices, now 35% higher than in 2020, show no sign of coming down. In fact, they continue to increase. And interest rates remain high. Even the new head of the Federal Reserve will be unable to bring them down anytime soon. And that leads us to home prices and the demand for real estate. Here's what's happened with home prices. Starting in 2020, a surge of demand sharply boosted prices that today are 60% higher. 60%. And if we look at the increase each quarter compared to the same quarter of the previous year, they're still rising at a 3% rate. This might suggest that demand is still pretty good. But let's look at home prices in Texas, a large and rapidly growing market where we would expect demand for home prices to be strongest. The increases there are very close to zero. This is a sign that all is not well in real estate. that high prices have narrowed the market of buyers so much that true supply and demand are highly uncertain. Data on mortgages supports this view. New mortgages have been at record low levels for years, less than a third of normal volume. This is why home buyers have been cutting jobs. Pent-up demand for homes may be high, but actual demand is very weak. And this is why further slowing of the economy and the further disappearance of well-paying jobs will lead to a major readjustment of home prices, not just in Texas, but around the country. There will be fewer buyers just when more people will be forced to sell. That's it. In this time of uncertainty, it's important for bankers and investors to stay on top of local economic and real estate developments. Local Market Monitor provides the data and analysis they need with local market reports and investors' meta-analysis. Thanks very much for following along. This is our National Economic Outlook. I'm Ingo Windsor.